Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing BP stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. BP is a multinational oil and gas company. It is one of the world's 7 oil and gas supermajors. It is a vertically integrated company operating in all areas of the oil and gas industry, including exploration and production, refining, distribution and marketing, power generation, and trading. It also has renewable energy interests in biofuels, wind power, smart grid, and solar technology. The company is headquartered in the UK and was founded in 1909. It trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Xetra, Boerse-Stuttgart, BATS, and London Stock Exchange. Let's get started with the model. This is a large cap company, 85 billion market cap. They're trading at $26 a share, and they have 3.3 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have lots of free cash flow every year, except in 2020 when oil prices crashed. It seems like they lost money that year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also really positive each year except a big negative in 2020. Revenue is the sales for the company, and that was close to $300 billion in 2018. It dropped a lot in 2020. It is coming back in the trailing 12 months at $209 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2020 revenue. $17 billion was from upstream. This is the first step of the oil production process. This is the exploration and production part. This is when a company has to identify if there's gas or oil deposits at a certain location, then extract that. And that was $17 billion. Their main business is downstream. This is the last part of the oil production process. Midstream is storage and transportation. Downstream is refining. Because when oil is pulled from the ground, it's useless. You can't do anything with it. You have to refine it, meaning you have to convert it to something you can use, like jet fuel, gasoline, petrochemicals, and that's most of their business, $163 billion of downstream. $64 billion of their revenue comes from the US. The rest is outside the US. They do $5 billion of revenue in crude oil, $64 billion in different oil products, then $13 billion from natural gas, LNG, and NGLs. NGL stands for natural gas liquids. NGLs are used in the manufacturing of everyday products like cell phones, plastics, and a lot of other things. LNG stands for liquefied natural gas, and this is mainly methane. They take natural gas and cool it down to negative 260 degrees Fahrenheit. This makes it a lot easier to transport as well, because it takes up 1/600th of the volume of regular natural gas. They brought in $10 billion of revenue from non-oil products. This $89 billion of other operating revenue, this is the money they generated from derivative contracts. So they hedge themselves by taking out swap contracts. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The cost of the oil and also cost of labor is a big cost of revenue. Also depreciation and amortization. Revenue minus cost of revenue gives you your gross profit. Then below that is their operating expenses. And then below that is their operating income. And they did have negative operating income in 2020. Their operating income was really strong in the other years. They have over $70 billion of debt on their balance sheet, so they paid $2.8 billion of interest on their debt. And the bottom line of the income statement is their net income. It was pretty good every year except in 2020, a big negative. When you look at a company with a lot of fixed assets, like an oil and gas company, sometimes the income statement isn't the best indicator of how the company's doing. The statement of cash flows is, and we'll look at that in a little bit. This is their most recent quarterly report. This is their third quarter 2021 report. This is directly from the company's website. They break down their revenue. $36 billion is from their regular business. They also report the revenue from their investments in other companies. That was $200 million and $1.1 billion. $158 million of interest income. This is the interest they earned on their investments. It looks like they sold a business unit or maybe some fixed assets. That was a $235 million gain. So they had $38 billion of revenue and other income in the third quarter. They had $24 billion in expenses in acquiring the oil, $6 billion in production and manufacturing, $4 billion in depreciation, and then general and administrative expenses, about $3 billion. They did have a really small profit in the third quarter of $193 million. Even though they had a pre-tax loss of $495 million, they still paid $1.9 billion in taxes. So they had a net loss of $2.3 billion in the third quarter. Why would a company pay so much in taxes if it lost money? Because a lot of things on the income statement, like impairments or certain types of write-offs, get stripped out when calculating taxes. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generated from its operational business. So you could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. It's possible on your income statement you can have a large loss, but you actually generated lots of cash flow. That can happen if you have a lot of write-offs. If you earn $50,000 at your job, and say you generated $40,000 of cash flow because you paid taxes on that $50,000. But what if you had a huge write-off? Say you bought solar for your home and you bought a Tesla, and say you had $55,000 of write-offs. So your income is $50,000 minus the $55,000 of write-offs. So on your personal income statement, you had a net loss of $5,000, but you generated $40,000 of cash flow. That's how a company works, but it's a lot more complicated and there's a lot of moving parts going into a company's financials. But that's a simplified way of thinking about it. And this company has to spend a lot on CapEx because they have to maintain all their projects and all their property, plant, and equipment. They also have to invest a lot into newer things. They're trying to grow their green energy business as well. Operating cash flow minus CapEx gives you your free cash flow. And 2020 was a rough year. Oil prices were low, so revenue was a lot lower in 2020. So they had negative free cash flow. But it's come back up in the trailing 12 months. It's actually higher than 2018. They do pay a dividend, but another way to reward shareholders is to buy back stock. They bought back $1.5 billion in 2019, $776 million in 2020. When a company buys back common stock, it decreases the shares outstanding, making your shares more valuable. But every year they add debt, especially in 2020. They added nearly $12 billion of debt in 2020, and they only paid down $89 million. They added debt in the other years, not as much as 2020, but they added a decent amount in 2018 and 2019. Debt is a cheap way to finance growth. It's a lot cheaper than raising equity. Let's look at their third quarter statement of cash flows. First, let's look at the cash flow from operations section. And the way you calculate CFO, you start with your net loss. That was negative $495 million. Then you have to add or subtract the non-cash items on the income statement and then adjust for changes in working capital. So even though they reported a loss, they actually generated $6 billion of cash flow. In the US, they start with net loss. It appears in the UK, the CFO section starts with loss before taxes. It's the same end result in either country. The taxes are accounted for in the CFO section. So to calculate CFO, we add $4 billion in depreciation. That's a non-cash item that brings down your net income, but we have to add it back here on the CFO section. We pass through a $784 million gain in their investments in other companies. We have to minus that out here. Then you have $219 million of stock-based compensation. Here's the income taxes down here. They actually paid $1.4 billion. They had a cash inflow of $3.9 billion from working capital. So they generated $6 billion of cash flow in the third quarter. Let's look at the investing section and financing section in their third quarter statement of cash flows. The top half of the investing section is their investments in CapEx. That's $2.6 billion in property, plant, and equipment, $53 million in acquisitions, and $200 million of investments in other companies. And they generated $332 million from the sale of a business. So in the third quarter of 2021, they had a cash outflow of $2.6 billion in their investing section. In their financing section, they bought back $900 million of stock. They paid $500 million on a lease liability. They added $2.4 billion of debt. They paid down $6.7 billion of debt. They issued $859 million of perps. Perpetuity bonds are just bonds with no expiration date. They paid out over $1 billion of dividends, so they had a cash outflow of $6.8 billion in their financing section. Let's look at the capital structure. They have $75 billion of equity, $72 billion of debt. They're 51% equity, 49% debt. Their net debt is $41 billion. And I gave them the middle whack on Finbox, 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $110 billion. We discounted those numbers back to today using a weighted average cost of capital. We get a value of the company of $95 billion. We divide that by 3.3 billion shares. And we get a calculated stock price of $29. They're trading at $26, so they're trading at 11% discount. It's a buy according to the model. The average analyst projects their revenue to grow 2.1%. So I grew their revenue 2.1% for the next 4 years. That's how I got their future revenue estimates. To calculate their future free cash flows, first I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 3 free cash flow numbers. I excluded 2020, and I divided by these 3 revenue numbers. So I multiplied their future revenue estimates by 3.2%. That's how I got their future free cash flows. I calculated the future free cash flows for 2021 and divided by 4, just to get 1 quarter. I was surprised how low BP's free cash flow over revenue was. It was only 3.2%. And I excluded 2020. They had negative free cash flow in 2020. If I included it, it would have been even lower. And I looked at similar companies. Exxon is not that much higher. Free cash flow over revenue for the past 4 years is 4%. But Suncor is 11%, Chevron is 9%, and Petrobras is a really high 23%. When you look at a company, you want to look at how much revenue they bring in, but also their margins, how much of that revenue they convert into profit or free cash flow. Simply Wall Street values the company at $27. They're saying it's 4.5% undervalued. 3 analysts priced this stock and the average price target was $34. This is where the stock has been trading the last 5 years. You can see at one point it was close to $50 a share, and now it's about half that. Most oil and gas stocks are correlated to the price of oil. So this bottom chart is the price of oil the past 5 years. You can see when oil crashed in 2020, so did this stock price. Before the oil crash in 2020, the stock price moved really similar to the price of oil. But after the crash, the price of oil has come up a lot, but the stock price hasn't come up that much. You can see Chevron's stock price came up quite a bit since the drop in 2020. So Chevron stock is more correlated to the price of oil than BP's. Definitely more so in the past 12 months. But you may be thinking BP is a UK company and Chevron is a US company. That could explain the difference in the stock price. Maybe the reason BP's stock price hasn't come up is because UK is more affected with oil than the US. But this is Exxon's stock price and it moves pretty closely with BP's. So for some reason Chevron is doing much better. And Exxon and Chevron are both US companies. And they have a beta of 0.86, so the stock moves less than the market. It's gone up 23% in the past 52 weeks, while the S&P is up 24%. The 52-week low was $20, the high was $30. And the stock is trading below its 50-day and 200-day moving average. Over 10 million shares are traded each day on this stock. All the shares outstanding are on float. 9% are held by institutions, and less than 0.5% of the shares are shorted. They pay a really nice dividend, over 5%, and they cut their dividend a lot, mainly because the stock price went down so much. And they're paying out 59% of their net income, 50% of their free cash flow, so they can easily afford this dividend payment. Some investors feel when the number of employees increases, that's a bullish sign. But in this company's case, it's decreasing. It was 80,000 employees in 2015, now they're down to 64,000. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd be a little under $11,000 today. The biggest shareholder is BlackRock at 9%, then Vanguard, Norges Bank, State Street, and UBS. Let's look at their financial ratios. They have great price multiples, A really impressive PE of 11.5. That means investors are paying $11.50 for $1 of earnings. The way you calculate PE is stock price over earnings per share. Their price to sales is 0.4. That means their revenue is more than double their market cap. And their price to book is also really good at 1.1. They have a good return on invested capital of 10.6%. They can cover their interest payments over 5 times. They have a good ROE at 10%. They have a good current ratio of 1.2, so they can cover their current liabilities with their current assets, but their quick ratio is 0.8. In the US, they list assets most liquid to least liquid, but it looks like in the UK, they do it the opposite, least liquid to most liquid. They have cash of $31 billion, inventory and receivables of $25 billion. The company seems to be well capitalized. They generated $8.7 billion of free cash flow in the trailing 12 months. They have over $12 billion of working capital, and they pay out over $4 billion in dividend payments, so they have nearly $17 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 10 companies in the same industry as BP, and if BP has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So their ratios are really good compared to the average. They have a great price to sales, price to earnings, and price to book. Their average and current ratio. They're better than average in ROE. They are worse than average in debt. And they're a little less than average in market cap. And they pay a really good dividend, over 5%. Average is 4.3%. So to summarize, I have them trading at 11% discount. But I know a lot of people buy this stock for that stable dividend. So if you're looking for a stock with a good dividend, I think this is a pretty safe one. Oil is an extremely important commodity, and the demand for oil still goes up, even with renewable energy. Plus, the company is growing their renewable energy division as well. So I think this is a great long-term hold. I rank their free cash flows 9 out of 10, their revenue 7 out of 10, and their ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.